Today, folks, we're diving into Canada's largest company's earnings today, which is, of course, Royal Bank, man. We've been diving into the financial sector for those of you that love those juicy dividends, that wonderful passive income from these mega banks in Canada. And you got to pay attention to this because it gives some real insight into what's happening in the Canadian economy. If we're heading for a recession, if it crashes around the corner, but we're going to break this down, try and simplify it so you can digest it. And if that is a conversation you'd appreciate, damn it, go down there, hit that like button if you're on a path to financial independence to perhaps one day retire early, because of course, I'll bring you these updates here as they come along. But Bank of Nova Scotia posted yesterday, and we covered it as the stock jumped up a nice 3.5 percentage points before dropping and giving up half those gains today. The entire markets are tanking, and they're taking the financial sector with it, which came as a bit of a shock. Thought this would have kept going higher. I mean, this is the first time in over a year that Bank of Nova Scotia beat their earnings per share estimates, beat their revenue estimates. The stock is going down. So what's causing this? Well, I think this summarizes a very good point here. That Scotiabank and BMO prepare for near-term loan weakness and better times ahead. So let me just read you the kind of top here, and I'll give you some anecdotal information. But the start of the first quarter of bank earnings saw Bank of Nova Scotia and BMO put more money aside for loan losses that may go sour in the near term, while they forecast better conditions ahead. So it's this mixed bag of being like, it's going to get better, but it's going to suck in the near term. Now, we expect North American economic growth to remain subdued in the first half of this year before recovering toward the end of the year on the back half of lower interest rates. This is coming from the chief executive of BMO. And on the Scotiabank side of it, they said similarly warned of a lull in the Canadian economy for the next few months, even as banks in Latin America markets show more promise, but all around the long-term outlook was positive. Now, our official forecasts are no longer calling for recessionary conditions in any of our operating geographies over the next few years. So the banks are basically saying, hey, the economy is looking pretty strong, yet why are we continually putting loan loss provisions aside? Well, again, loan losses don't guarantee that these loans are going into default. It just basically says, hey, if your interest rate and your mortgage is coming up for renewal and you're coming to renew at a higher rate than you had, but your income for your household hasn't changed, that means that loan is at a higher risk of defaulting, which puts it at a lower credit quality, which means the banks, by regulation, at a fear and, saying, hey, in case you default, we need to put some money aside just to protect ourselves. But if that doesn't happen, in the future, the bank can actually take that money back. And I've been kind of spouting this mantra over the last day or two, but taking a look at Royal Bank, this has been one of the best performing banks, 5 years up 26.5%. It's a very steady Eddie company. It's Canada's own version of Apple. I know there's not a one-for-one comparison there, but I mean, it is the largest company at $183 billion, paying a 4.22% dividend, which it has over doubled in the last decade from 67 cents to about $1.38, just of doubling of that dividend, which is wonderful for those of you that just want income from very stable, large traditional assets that have been around for a very, very long time. So what I find interesting is I was just reading through some of the highlights, and then we'll talk about their direct earnings, but they were talking about commercial real estate, saying that they put a credit, basically, they had to put some paying attention to the credit losses here for the ratio on their performing loans is 3 times higher than the pre-pandemic level. So this is the allowance for credit losses, but apparently it's 4 times higher in the US than it is in Canada. So that's an interesting sign, right? The US is actually experiencing more trouble than Canada is, but you can see they have this really interesting $28 billion of diversity in office, real estate, multifamily, industrial, and warehousing. Retail at 14%. I should really dive back into the industrial and warehousing real estate sector because it's probably one of the most interesting that continues to do well on the back of e-commerce. Now, we can see that they're kind of, trending higher, the provisions for impaired loans, and this was expected. If we actually take a look at the impaired loans, and again, I'm just paying attention to real estate because it's the largest amount of outstanding debt for all the banks. But if you take a look, they have about $401 billion in mortgages out there, which is pretty fascinating. And basically their 90-day past due loans set at about 19 basis points, which, to keep in mind, I think Bank of Nova Scotia's was 20 basis points, which is incremental. It's very non-impacting to any major extent. I mean, it's pretty great to be in this higher interest rate environment and not seeing like a huge slew of people going broke and having to, put their homes up or getting them forced into sale so the bank can retrieve its mortgage debt. But still, this is great, right? So there's nothing complaining here. It's also nice seeing, if you scroll down a little bit, you can see about 27% are variable, 73% are fixed, owner occupied at 86%. It's neat to see 12% are condos, detached 72%. Also uninsured, $304 billion, or I think it says up here $339 billion. The uninsured is great because those are people that put a higher deposit down so they wouldn't have to take out mortgage insurance. I've stated this as well. It's a really great thing to see. But diving into those earnings specifically, and what I really want to point out here is they did $13.48 billion in revenue, right? Provisions for credit losses grew to $813 million, which has consecutively been up year over year and quarter over quarter for Royal Bank. Not the best thing to see, but they were able to actualize a lot of this, bringing their net income to about $3.58 billion, which was a record over this time last year, totaling about $2.50 per share. Not quarter over quarter growth like some of the banks we looked at, but over last year, this is the growth that, is great. It's super awesome. But they have been diluting a little bit, I've noticed, basically just even over last quarter. Curious if that's stock-based compensation or if it has to do with HSBC, because I know they're buying their Canadian counterpart in this massive deal, which would continue to solidify their monopoly as the largest, Canadian financial institution with the very few. It's just kind of crazy, how the banks operate here compared to the States where they have a ton of different regional banks. Whereas in Canada, we're controlled just by a handful, right? But yeah, so this was kind of where we sit. These bank earnings are great. The outlook is looking better, but unfortunately, higher interest rates, right? And the way the bank's only going to benefit from this is if they start cutting interest rates. I really thought the bank would have made more money in a higher interest rate environment. Some of them are, but the fact is they're not getting a lot of new mortgages, a lot of new loans because people can't approve for them. So that's why they're saying the outlook toward the latter half of this year will be a lot brighter, because if they cut interest rates, more people will be able to get approved for loans, and it'll continue to grow the balance sheet and the assets of these banks. So I guess that's kind of where we're sitting, and similar to the telecom giants and the companies that actually have debt, they're being directly hindered by the higher interest rates, right? So we're still kind of stuck in coming out on the eye of the storm of this interest rate cycle. And I mean, it's still affecting a lot of companies, but we can see most of the markets are red today anyway. So it might just be bringing down the banks with it. And crypto is the only thing that's been a real outlier today, with Coinbase. If you didn't see, Coinbase had to lock up. I guess they couldn't handle the transaction volume, and it caused this massive spike and drop in Bitcoin price. Very interesting to see that happening today against the back of a red stock market. So yeah, it's always a wild time. It's like the Wild West out here. It feels like every day is something new between AI, crypto, chips, and all this stuff. So it's been fascinating to say the least. But I feel like a lot of people turn to these Canadian banks and these Canadian dividend stocks for stability, so you don't have to worry about the volatility of all of this stuff. But I'll pass that question off to you. I'd love to know what you think in that comment section below.